Good morning, everybody. I'm Dave Miller, and welcome to the Iress live stream. What's next for equity release? Thank you for sparing the time to join the live stream this morning. Just a few bits of housekeeping before we start. If you want to ask a question, please post this via the Q&A, and would be grateful if you could add your company name and your name. We will do our utmost to answer all the questions in the session, but if we aren't able to, we will respond to them all individually after the event, and a recording of the event will also be available shortly. Session will last for approximately 45 minutes, and after the event, you will receive a short survey to complete, which we would be grateful for your feedback. Now I'd like to introduce our panelists, and many thanks to them for attending this morning. So from Legal and General.
Hi, I'm Dave Stratton, Legal and General Home Finance Distribution Director. I'm responsible for our intermediary sales team, delivering relationship support to our brokers.
Morning, Dave.
Morning.
From More to Life.
Paul Glynn, Director of Sales at More to Life, and our frontline BDMs and telephone team and our broker support team reporting to me.
Morning, Paul. And from Pure Retirement.
So Chris Flowers, Head of Intermediary Sales, similar to both Dave and Paul, responsible for our intermediary team that I look after and serve the broker community. Been in the industry now, this is my 11th year, working equity release.
Morning, Chris. Right then, gentlemen. For the people attending, we're sort of looking at what next for equity release, and particularly looking at efficiency, products and rating, and market dynamics. So if you've got questions particularly around those, it would be good to hear from you. So kick off first of all. So Iress has recently published the 2021 Mortgage Efficiency Survey, and copies are available via iress.com. The biggest takeaway from that was that the need for efficiency hasn't changed. So sort of first question to the panelists. In supporting improved efficiency, we at Iress have introduced over the past 12 months real-time quotations, KFIs, and more recently the ability to apply online for equity release products. Be interested to hear how this has improved the overall process and experience, and what further improvements do you anticipate? Can I start with you, Chris?
Yeah, of course you can. I think the first thing, let's kick this off the way it means gone, is that I think, and hopefully Paul will agree, is that the only way the tech efficiencies that certainly Iress and other tech providers are bringing to the party, I think the only way we're really going to get there to improve the whole advisor journey is if all lenders get on board with doing that. And I think for me, that is really the key point around what Iress are trying to do here, is that, as you'll probably agree, there's only probably a small handful of lenders that are actually at the point where you're able to do a KFI. I think there's only maybe one way you can actually do the quote and apply, but I know Pure are working to get that very soon in place with Iress. But I think, what we really need as an industry for this to really help advisors is, I think that every lender, there needs to be a kind of a benchmark where every lender tries to get to, where it's not just one or two advisors where you can automatically get a KFI at the click of a few buttons. That all lenders offer that same service for these brokers. And I think that is probably where, as an industry, we've maybe been held back in the last couple of years, in that, ourselves and More to Life were the first to do the KFI probably about 2 years ago, was it, Dave?
Yeah, about that now, and we kicked it off.
And we've not really seen the other lenders, flood to that market. And I think that's really where we need to be aiming to get is, yeah, it's great for, Pure to be able to be one of the first in doing that. But I think to really, really have the impact of the advisors, we do need to see some of the other bigger traditional lenders really step up and join us to the party, really.
Okay, thanks, Chris. So on that note, Dave, can I pose that question to you?
Yeah, I think that sounded like a natural handover, didn't it? Yeah, I completely support the need to kind of drive, the growth of efficiency through technology and integration in this space. I think as a marketplace, there are others that are further ahead in financial services more broadly, and in the mortgage marketplace particularly. Earlier this year, we launched a new broker portal for KFIs and applications. And that was part of our kind of first step along the process of being equipped to be able to develop further in this space. So I agree we need to move on to kind of API links, etc. And I think that's definitely a priority for us going forward. So the new portal, first step along the way, more to follow.
Okay, and Paul, obviously more to life along with Pure been at the forefront of this development. From your own experiences, how's this gone down within the business?
I think it's much needed, Dave. I think we see this very much as a journey. So recognizing some of the comments from the other panelists that you know this is a journey that will all be on at different speeds, and I think the same applies to the intermediaries themselves. So we've seen at the one end of the spectrum, people really embrace this. So a chance for them to avoid all of that rekey and that swivel chair process from research into driving the KFI and then on to progressing the app. And some people have recognised, the huge saving that the development work and real-time rates being available can mean to them. And we've got others that are still doing dual processes. So, I think we do need more of a population of lenders on board to make this work. But at the same time, we also need to all have a consistent message that there are efficiency gains for intermediary businesses where the margins, if we're honest, are quite thin in some cases, where this can make a real difference.
Yeah. Okay. And just a sort of supplementary question to you and Chris, because obviously now you have the ability to change your rates at will. What differences has that made to the business, and how do you see that implementing further changes going forward?
Want me to go first there, Paul?
You want? Yeah.
I think from a Pure perspective, so earlier this year we launched the Pure pricing engine, which was a huge step forward for the business. It allows us to price granularly, so more competitively for our customers. There's huge efficiency gains as a business. Thought back to a few years ago when doing a rate change would mean that would have to get colleagues manually to go and update the systems, and it might not be as live now. We can get rate changes in that same day, which is fantastic. We're also conscious at the same time that we don't want to be changing too quickly, so that the advisors don't really know where we are in the market. So I think everything with technology, we need to embrace it, but at the same time work with it and not kind of be too smart and too clever. But I think absolutely. Now being able to change quickly, especially when rates are falling in a falling market, both Pure and our funders, we want to make sure that we're able to deliver the most competitive rates for our customers as quickly as possible. And having those API links to be able to do that is certainly an absolute win. And I think, what we'll all agree on this panel is it's all about, ultimately it's all about customer outcomes, and getting the customers the best product as quickly as possible is absolutely key. And it's also working with our advisor community as well to make sure, it's fine making these changes, but we then it's that other part of making sure we communicate that to the advisors in the right way.
Yeah. Okay. Thanks, Chris. Paul?
And I agree with Chris, and this is a logical next step for the market once the technology track to run on and pass messages backwards and forwards is laid down. Then being able to offer customers a more personalised rate and value on an individual basis is crucial. But it's it's something that we've been keen to do carefully to help advisors through that change, having learnt the lessons from the medically underwritten equity release market, where personalised rate is something that takes a little bit of time for people to understand and work through. So our teams are preparing now to help advisors on the next stage of the journey as we prepare to launch that.
Okay, well, that leads nicely into my next couple of questions related to rating specifically. So first part, in the mainstream mortgage market, the expectation is the energy performance certificates will be the starting point for greener product journey. So what impact do you see that having on the equity release market, if any? And then secondly, given the point you were making, Paul, about medical underwriting, etc., do you foresee the requirement for any greater level of data capture occurring prior to obtaining a quotation and what perceived benefits this would bring. So I'll start with you, if I may.
Saw the medical one coming, Dave. I wasn't quite sure on the energy certificate one. Okay, so on the we'll tackle the energy certificate one first. I think that I think it's still an open question. So in Q1 this year, there was a report published which suggested that lenders might have to track and disclose energy performance ratings of the properties they lend against. I think we still need to see how that shakes out, and given that a large proportion of the equity release market is linked to people using it for household renovation, you would hope that at somewhere in that consideration process is that there's a bit of dispensation that if the cash is released to improve that property, there may be some release clause there where we don't necessarily have to track it as heavily. But let's see how that shakes out. Just to go to the underwritten question, I think we very much took the view at the start of our journey that we wanted binary yes/no questions. That was in a market of almost one at the time online. That was what we felt was the most appropriate way forward. I think the market is moving, and if we're able to offer, working with our background partners, a more granular underwriting decision and a more personalised rate, then expanding the question set or accounting for wider sets of conditions if it drives value to the consumer is no bad thing.
Okay, thank you, Dave.
Yeah. So first of all, on the green side of things, so I think we do foresee changes coming in this space, albeit slowly. I mean, there was another report earlier this year that said actually in terms of property value, if you look at an A/B rated compared to a D rated, there's only about sort of 1.7% difference at the moment in terms of property value, and that stretches to about 3.5% if you're talking about F and G rated. So the price of properties yet isn't really baking in that kind of EPC differential. But 60% of UK housing is D or below. So there is definitely an opportunity. We actually saw an opportunity to support customers with home improvements in this space. Last year, we launched a green cashback. So if they were using the money to have certain energy efficiency measures implemented in terms of their property, there could be an additional cashback that we would pay after those works are completed. So that's one of the ways in which we've seen ourselves being able to respond as a lender. I think the pricing and that kind of bespoke granular pricing, I do think this, along with a number of other measures, we will see with the use of technology being an enabler coming more to the fore. I guess talking to brokers and intermediaries, a little bit of mixed feedback in that there's an acceptance that if you have that bespoke pricing, yes, it's specific to the individual, but where are winners, there are losers. So where you've got average pricing, actually that does have a benefit for some consumers and some borrowers. So I think it's not a one-way street, but I think it's the direction of travel.
Okay, interesting. Obviously, with the average pricing, the whole treating customers fairly aspect comes into play, and be interested in Chris's view here.
So to answer on the EPC certificate, I think probably so here at Pure we've looked at it, and I think it is a journey. I think at some point the industry will have to move into that direction. I think when we looked at it, one of the things is obviously in the mortgage world, the majority of cases are done for purchases, so you need an EPC certificate. When we look at the equity release, it's only a real small amount of cases where it's used for a purchase, proportionate to everything else. So we were conscious that we didn't want potentially to add in something else where there's a cost or a customer might not have it to a process that already is quite a lengthy process for our customers. So it was like, yeah, we fully understand that energy performance is a way forward, but it was like for some of our customers, you've got a lot of customers who may have had the property for a long time, they might not have got that certificate. Asking to make it a requirement to have that done, A, is an additional cost. Who would bear that cost, and B, do the customers want to do that? Would it slow it down? And I think hopefully we can get to a point where it will become a driver. But I just think at the moment, it's, as I say, it's not as easy in the mortgage market world where if you're doing a purchase, you need to get that certificate anyway. So I think that's, and then in terms of the granular pricing, how far do you go? I think if you asked 100 people, you'd get so many different answers to that. As I don't want to sound like a broken record, but I think I'll come back to the same point. Everything we do needs to be about our customer, and it's making sure that the customer has the right benefit. And then also at the same time, what we don't want to do is make it that, you know, the fact finding process, you know, which can take up to maybe an hour and a half, 2 hours on a face-to-face visit, then is adding on another hour because, you know, we want your inside leg measurement. And you know what we've tried so hard and done so well in the last, certainly since I've been in this industry, about opening up this marketplace and make it more accessible and making sure that advisors can explain to the customer really simply how the products work. And I think we just need to be conscious that we don't want to add in that extra layer of so much more detail that, you know, customers then get put off by it. So I think it's a fine balance, but ultimately the more data we can collect, and I think over time as lenders build up more data, then they'll be able to model it and be able to offer better pricing. So the sooner we start getting some more of that granular data, the more that customers can benefit.
Okay, thanks, Chris. Just a question posed from later life lending options and in relation to EPC. Could the volume of low EPC rated properties cause a lender to restrict the number of new cases they would accept from those kind of properties so that it doesn't impact on the potential value of selling the book at a later date? Anybody like to respond to that? Don't all be silent, gentlemen.
Yeah, well, I'll give it a go. I think these answers, I don't think we would limit how many on a book did or didn't have that certificate. Yeah, so I don't think it would be an issue for us, certainly not at the minute.
No, I think you can obviously see an argument for it to be factored into the price, the rate at some point. So I think it's more likely to be through that pricing mechanism rather than a kind of cap.
Okay, good. So in terms of what's happening in the market, interesting to see the press earlier this week related to Standard Life entering the equity relief market, partnering with Key to provide lump sum and drawdown products. So I suppose the question, gentlemen, you know, is there room in the market for further entrants? And does this sort of white label approach mean it's really far too difficult for new entrants to enter without support from existing players? And if so, why is that? So, Paul, I think your name's first on that question.
I think, you know, the immediate response to that, Dave, is there's absolutely room for more entrants in the market. I think any of the high street brands that play in the market has got to be a good thing. I think high street names like Standard Life coming in has been trailed in the press this week is only going to be a good thing for awareness, for customer engagement. There's 13 providers listed on the Equity Release Council website and in our market, and if you compare that to the residential market, there's hundreds of mortgage lenders. So you know we've got a long way to go to say we've got to saturation point on innovation and brand. And it promotes competition, which has to be a good thing for customers. Just to pick up on your white label point though, I think coming into any new market as a new brand is challenging. I think there are a couple of unique aspects to the equity release market that means it's probably even more challenging. It's one of the most regulated products out there and probably one of the most heavily scrutinized in terms of customer outcomes. So white label deals or supported partnerships do enable people to come in and test the waters, and it's been done before. It's a common model, and it can be that kind of useful bridge between market contemplation, early engagement, and then people fully taking the plunge and driving their own products and market participation. So I think hopefully this is the first of a few high street brands that start to take a look at, if not the center of the equity release market, the areas that are on the periphery.
Yeah. Okay. Thank you, Paul. Dave, any views?
Yeah, I concur in terms of, I think there is always space for quality brands that are going to help the product become more recognised and mainstream for consumers. So that's a positive. In terms of the white label approach, I obviously don't know the detail of the specifics around this particular entry, but I guess for me, I sort of took a step back and thought it's probably about speed to market rather than it being fundamentally too difficult to enter this market. I think if a player is a provider is determined to be in the market and invest for the long term, I think they will. But this for me, I was thinking more, say, speed of market.
Chris?
Slightly biased. Standard Life always hold a special place in my heart because I started out in financial services with Standard Life back in 2002. And I thought they were a great business. Obviously, they've been sold off since, but still, and I think their brand is really, really strong. And I think we're all aware that in terms of the white labeling and using key group, it's just there. I think, as Dave said, speed to get to market. A lot of these businesses, they commit a strategy that's signed off by board that they want to enter a certain, market in a certain space of time. And let's be honest, the easiest way to do it is partnering up. And also in this market, and I know it's not as pronounced as it was, but when the market's dominated by a couple of distributors, it's maybe say 3 or 4 now, it's so difficult to kind of break into that without the support of some of those distributors. So, it makes sense. And for me, for the industry, I know as working for Purewell, let's be honest, our brand isn't as strong with consumers as maybe some of the other big names. I know how difficult it really is. So having another brand in that marketplace, let's be honest, the funding for the Standard Life, and I don't know the commercials, that funder is already in the marketplace. So it probably isn't going to be much difference in terms of funding, but what it is doing, it's hopefully going to open our market up significantly because consumers are going to see that brand, and I'm hoping over time that Standard Life will hopefully put some money behind it and put some marketing behind it direct to consumers, and that absolutely can only be a massive win for everyone on this call because it'll hopefully grow that market and reach its potential that we know it's really got.
Yeah, thank you. I'm in an R as to which question to go next because comments coming back lead either way. So I'll go about growing the market, and obviously the recent stats released by the Active Release Council for Q2 show customer levels returning close to pre-pandemic activity and unlocking nearly 1.2 billion of property wealth, up 2% from Q1. So key factors to further growth in the market and in the longer term, what impact, if any, do you believe the introduction of the 1.25% health and social care levy introduced by the government will add? Dave, can I pose that one to you first of all?
Yeah, I think it's great to see the market kind of returning to those sort of pre-pandemic levels. I think the kind of factors driving growth remain unchanged. If we look at the demographics, so property being held by older ages is obviously significant. We've seen property growth, so property equity has been growing, so that will help drive the market. We've seen obviously there's been a hiatus in the more aspirational spend, so people obviously spending on things like holidays, etc., has very much diminished, and we would expect that to come back at some point. But what we are seeing is more of a move into intergenerational planning, lifetime gifting. And with that comes sort of kind of larger loan sizes as well, which I think will be a dynamic we'll see. We've seen quite a growth in kind of $1 million plus value properties coming to us where we wouldn't perhaps seen quite as much of that pre-pandemic. So there are a number of things that are driving it now and will continue to. I think looking further ahead, when we do research, we see actually, if you go beyond the 55 plus, which is obviously the market we're looking at active now, in the 40 to 55 age group, there is a much greater willingness to consider using property equity in the way of lifetime mortgages. So that speaks very well to the kind of future opportunity to engage with clients as they kind of move through the age groups. And in terms of sort of where we are in terms of care, I think there has always been an opportunity, and hopefully the focus around social care will drive it further forward for this type of product to be used, particularly for domiciliary care, where people want to stay in their house for as long as possible and receive that care and not be forced to kind of move into a care home. Obviously, as we know, if people do move into care, then at that point there's a kind of break point in terms of the way the product is currently designed. So I think domiciliary care is a continuing opportunity, and I hope the whole kind of conversation just drives more consumer awareness around social care and costs and how to meet them.
Thank you. Paul?
I agree with what's been said. I think with regard to the volumes in the market, I think the fundamental drivers are definitely unchanged. I think there's probably two things just to be mindful of looking back over the last few months, and that the first is that I think we've yet to see an unwind of true unwind of discretionary spend, because I think as Dave said, there's not as much people could have spent it on previously. So we need to keep an eye on how the mix of uses changes. And then the other thing is, I think a lot of businesses themselves in the intermediary space have used the drop in rates and the kind of pause and hiatus caused by the pandemic to just take a look at their existing book of clients. And I think there's been a lot of rebasing of clients on higher, older case rates to be put onto more modern products. So we just need to be aware that's been happening in the background as well. But in relation to the moves on care, I think yet again it's another question mark or change that really means it puts the advisor at the heart of all of this. I think we need to start to continue. Well, we need to not start to, but continue to push that advice is the product in that space, not necessarily whether equity release is the solution or investment is a solution. I think it absolutely plays right into the heart of the expert intermediary that those clients really do need advice at that point.
Chris?
Yeah, I kind of, if I'm honest, I don't think our industry has fully recovered post-pandemic, and we were, I remember if we went back to March last year, there was a load of panic. How can we continue to do this when we need surveyors to go out and visit a customer's property? I also think, so equity release, let's not get away from here. We talk about the numbers and the lending, but let's take it back to our customers here. An equity release is a motive, a decision for everyone. It's a big decision to make, and let's put ourselves in a customer's decision making process where we've seen so much go on, so much uncertainty. Lots of customers probably are still not too sure what the outlook is, and so we've seen. I remember, I think it was about 12 months ago, I read an article, and they said there was so many what they've now called accidental savers. And I think a lot of our target demographic are in that area where they would generally spend money on going on holidays, treating the grandchildren. That's not been able to happen. So a lot of our customers who needed to release money, the absolutely fantastic news is they've been able to delay that decision for a couple of years. And I think what we've seen is, yes, the market is returning to the pre-pandemic levels, but that's really been fueled by something that David said around the larger case values. So, the average case size across the industry, I think if you were to survey everyone, it's probably gone up 30 to 40% post-pandemic. I mean, that's been fueled by first, a different type of customer that is now looking at this. And I always say this, that I think there's still some people have in their head that the typical equity release customer is someone who isn't financially savvy, who doesn't have any funds, and is using this plan of a last resort. Speaking to the advisor community, that absolutely is no longer the case. We are really now, a lot of the time, not all the time, a lot of the time dealing with clients who are a lot more sophisticated and who are tuned into being able to get a fixed rate lifetime mortgage, that starts with a 2 and that's fixed for life. So that is then driving this different type of customer. Also, look, we see in the press, all the time about house prices increasing. Having that increase in house price is absolutely helping fuel that, because customers can either release more because the property is worth more, but also customers are going, well, if my house is worth more, I can borrow that bit more because I know, how much equity I've got in the property. And we've also seen other lenders, I think as lenders increase up the LTV tiers, it's just helping fuel that. So I think my answer to the question is that I think there's still a long way to go. I think the figures from the council are slightly misleading. I do think there is more to come from this industry, and I think that's what really excites me more than anything. You know, I said at the start, I've been, you know, in this industry for 10 years now, and I think it's such an exciting time. We've mentioned new brands coming into, we mentioned that, you know, the low rates, and I think when we moved into interest rates falling, and it all kind of came around the same time when the likes of L&G entered the market and really pushed competition. And I think there was some feeling that probably wouldn't last long and that they would bounce back up to what they were. And I think we're now seeing that consistently now. We can go at that message, you know, as lenders and advisors to your customers to say, you know, these rates aren't what they were, you know, 7-8 years ago. They start with a 2, they start with a 3. They have this flexibility. And at some point, we get to a point where having a conversation about a lifetime mortgage, it just is very akin to discussing a normal mortgage. And I think that's where hopefully the industry can move forward.
Okay, thanks, Chris. Obviously, there is a large reliance in the equity release market on intermediaries. How do you think we can actually grow the fact that actually to get more intermediaries selling equity release? Dave.
Hi there. Yeah, I think for me, in terms of getting more intermediaries into the space, and we do see that growth, we see it happening. I think a lot of intermediaries are in the space in a way, but they're perhaps referring rather than advising. So it's perhaps how do we help give advisors and brokers the confidence to advise in this space and take on the advice themselves rather than referring. So there's a lot we can do as lenders, as providers, to kind of help that kind of education. I think if we look at, you know, putting the client at the heart of it, at the moment, sometimes the lifetime mortgage equity release advice is a little bit siloed. I think the more we bring it into that kind of holistic retirement planning, so it's not seen as something on the side, but just seen a natural part of the conversation that any advisor is going to have with their client about planning for retirement, rather than the kind of coming back to the point that was made earlier. This is no longer a kind of last resort. This is actually a pretty smart thing to do, given where rates are and given household equity. So bringing it into the kind of holistic retirement planning conversation, for me, it will help take this market forward and help grow, and hopefully bring advisors that don't see it as sort of a natural part of what they do to become more of a core sort of tool in their armory when they're looking to generate great client outcomes.
Okay, thank you. Paul?
I think that, you know, I agree with the comments from Dave there as well. But I think we've got to find more innovative ways, I think, of helping people bridge that step from client, you know, contemplating getting involved in the market, seeing those first few cases come through and maybe where people refer, to pushing them into their, you know, the right models to support them, whether that's, you know, helping networks train more people, whether it's helping the, you know, the clubs like Air and others, you know, bring more people through into the marketplace is all really important. And we shouldn't underestimate the part that technology plays in helping a new advisor into the market, where there are hundreds of products out there to, you know, to consider. And, you know, platforms such as Iress are incredibly important in helping people take that first step into the market with confidence. But I think we also need to just think about the helping people with their expertise, not just in the sense of the intermediary. I think, given, you know, a lot of what we talked about today is about transaction times as well. I think we've all got a piece of work to do to support the solicitors in this with the conveyancing, because a lot of the work we've done on transaction times, you know, technology can go quite a way in supporting moving transaction times down. Helping the advisor and improving their knowledge can make another contribution to that. But I do think there's a piece of work to be done with the solicitors, in bringing the wider general marketplace knowledge up to speed, because the research we've done shows that cases the way you don't use a specialist solicitor can take up to 30% longer to transact. So I think technology, advisor knowledge and confidence, and then looking further down the process at other areas of expertise is going to be crucial.
Yeah, I think when we ran this sort of nearly 12 months ago, I think part of the issue then was the time that it was taking for, you know, solicitors to get through a lot of the work that they were doing in relation to applications. So, Chris, any ideas on how we can help them, what we can do?
So going back to your initial point about growing the market, and I completely agree with everything that Dave and Paul have said. I think I take a slightly different spin on it. I think, you know, advisors will start coming to this market more and more, the more that their customers start asking them and talking about that product. And I think for me, that is really where this industry will start growing, is when, you know, you've got clients approaching their financial advisors. Now, I've seen about this equity release, I've heard it's really good. And I think, and the point that we need to do there is all about, and touching, bringing back to what we said about Standard Life coming into the market. The more that big brands and big companies start talking about this, you know, we saw Nationwide enter the market probably 3 years ago. The more that we can attract these big name brands, because until we do that, there's going to be a ceiling to what we can do. But the more that we can get, I mean, it would be great if there was some government support around an equity release and help, you know, an education campaign. And I know the Equity Release Council, I know they've started a big piece of work about educating consumers. That's going to be rolled out either later this year or next year. But I think those are the real types of things. Once our customers, because I think we'll all agree that it's only a small amount of consumers fully understand. They think they know what an equity release plan is, but, you know, what their opinion is and reality are two very different things. So I think there's still a lot of work to be doing on end customer education of products. And I'm not saying every customer should take out a plan, but just them having a knowledge so they can approach their advisor and have a conversation would absolutely, you know, change our industry overnight.
Okay, thank you. So we're getting close to sort of, you know, 45 minutes, gentlemen. So a single question to you each. If we're looking 2-3 years out, what innovation, where do you see the equity release market? What will have changed? Paul, can I pose that to you first?
I think hopefully we've seen a mindset shift within the industry to not consider ourselves a niche market. You know, this product and area of advice and innovation has mass market appeal. So hopefully, if you're looking back, you know, down the lens a few years from now, we've managed to, you know, step out of the niche framework and into mainstream, you know, consideration. I think we're well on the way to that, but some of the things we talked about today will help accelerate that further.
Okay, thank you. Chris?
So I'll try and tie in this answer to one of the questions that I've noticed have come in that was mentioned about what we're really discussed is the early repayment charges.
Mm-hmm.
And I really think it's such a difficult one, early repayment charges, because I think, you know, we talk about wanting to, you know, align lifetime mortgages with traditional mortgages. And I think the one big difference now with some plans is their early repayment charges. So I'd like to think that, you know, over the next 5 years, we could move that forward. You know, the more we align the ERCs to what a traditional mortgage is, that's another one of those barriers that we have in our industry. But then at the same time, just from a lender's perspective, the difficulty we have is that how these products are funded. I think sometimes the advisors feel that, you know, lenders are being unfair when we put these charges in. But, you know, when we start out these products, we have to model it that they're going to run for the lifetime of the plan. And so putting in these ERCs allows us to lend the money. And if they weren't in, it just makes it extremely difficult to model. But there's lots of work going on behind the scenes to obviously make them better. But I think there's just, you know, what I would say to the advisor community listening to is that, you know, as lenders, we don't want to put these punitive charges. We're helping to try and drive those, but at the same time, you know, we have to put something in to be able to model the products. And that's why, obviously, a lifetime mortgage is slightly different. But yeah, in answer to your question, I think I'd like to see that the early repayment charges are a lot more aligned across all lenders. There'll always be slight differences, but it just makes it a lot more easy for a client to understand and stomach. And I think that would then really open up our marketplace.
Thanks, Chris, and really good linking that to the question posed. Dave?
Yeah, so just to touch on that last point about early repayment charges, I mentioned we'd launched a new sort of portal earlier this year. In line with that, we now offer both fixed equity early repayment charge products as well as variable. So trying to give a bit more kind of choice and flexibility, but I agree there's more work to be done in this space. In terms of kind of innovation and change, I think it's in part sort of the message around making it a mainstream, not niche. But I think we need some support potentially in terms of regulation and the way mortgage advice for over 55s is sort of dealt with. So at the moment, we can have quite a siloed approach. And I'd like to see a position where regulation supports all of the options being considered in a consistent way. And I think that would really, really help drive the market and support the advisor.
Okay, thank you. Unfortunately, we need to call that a halt about now. Gentlemen, any last comments from any of you?
No, just thank everyone for attending. I know the world's, opening back up, but it's, it's great that we get these types of numbers so we can support these events. So I just want to thank everyone for dialing in today. And if there's any questions or any support you need from Pure Retirement, please feel free to reach out.
Thanks, Chris.
Absolutely, I think we'll ditto that. I know if any of the questions that have come through haven't been answered or are specific to one of us on the panel, I know we'll pick those up separately.
Yeah, absolutely. Thank you, David. So yeah, thank you everybody for attending the Iress live stream. We would appreciate your feedback in the survey that comes out. Thanks very much to Dave, Chris, and Paul for attending as well. And we look forward to everybody's feedback. Many thanks, everybody. Goodbye.
Thanks, everyone.
Cheers.